So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani, and I'm joined today by Lisa Hylton. Lisa is the host of Level Up REI Podcast, head of finance for a real estate tech startup, and founder of lisahylton.com, a commercial real estate fund management firm that was created to help accredited investors gain diversification across private commercial real estate investments. When she is not investing in real estate, you can find her hiking, dancing, Argentine tango, paddleboarding, practicing yoga, taking an evening walk, swimming, traveling, embarking on wine country getaways, and trying new adventures. Lisa, welcome.
Yes, thank you for having me. Just listening to that bio, I was like, gosh, did I write that? Wow. Oh my goodness. So happy to be here.
That's why I love doing live intros, because it's always great to get organic reaction after you hype someone up and they're like, wait a second, that's what I wrote about myself. I love it. Okay, so obviously a lot to get to today. Very excited to chat. Lisa's also a fellow Raise Master. Shout out to Adam and Hunter. But let's start at the very beginning. Kind of give us the Reader's Digest version of how you got into all of this.
Yeah, so it's been a journey. My current iteration of my business and my vision for the future has definitely evolved with time. I started off being around real estate through my parents. My dad was a contractor. He built 14 apartment units when I was a child. By the time I got to middle school, he was diagnosed with a brain tumor. And by the time I got to college, it took his life. But because he made those initial investments, we still have those properties today. And so it's a testament of being able to invest in real estate with a long-term vision and mindset. I bought my first property when I was in my early 20s, living in the Cayman Islands where I grew up. And I bought it because I loved it and I didn't fully understand, the running of the numbers, but I quickly got an education in those numbers. When the rent checks came in and they weren't enough to cover all the different expenses, and I was falling short for I held the property for 6 years and broke even the first year and lost money every single year after that for a total of 5 years.
Wow.
So yeah, it takes time when you pay too much for a property, right? And then end up with, you have a mortgage and then you have rent that's coming in, and you go through periods where the rental income market goes down a bit and you lose a tenant, and then you decide to rent it for a little bit less in order to get it going. And you also have HOA fees that are increasing year to year and eating up some of that cash flow. So definitely learned a lot there. And fast forward, after I sold that property, after moving to, on top of that, I was an in-country landlord for 1 year and an out-of-country landlord for a total of like 5 years. So at the point at which I moved to LA, in the tail end of holding that property, I got a bill in the mail for over $1,000. And I said, yeah, this one has got to go. So I sold it and I said, no more real estate, no way. And I always say that the universe has a sense of humor, because a year after that is when I ended up taking a job as a controller on private equity real estate funds, a job that I did for 4.5 years. And 6 months in, I realized, wow, people are making money investing in real estate. You just need to know what you're doing. And that's how my journey, this current iteration of my business and like where I'm going, has began.
Awesome. I love that. I love when people, well, I shouldn't say I love when people have a bad experience, because of course we don't want that, but we learn a lot from those. But it's always so fascinating when someone's like, yeah, I'll never do real estate again. Fast forward and we're in real estate.
You're back.
But I find that people typically have a bad experience in single family, some iteration of that. And then realize that scaling and economies of scale and all that in commercial are just exponentially better, and it makes more sense.
Yes. I can agree with that up until the point at which I took a job working for a startup that invests in single family homes. And I realized, wow, there's something here to the single family home portfolio space. So I'm always learning. And I guess that's the journey of this, as I said, all the iterations of like learning and getting the feedback and sort of saying, oh, wow, this is interesting. And then going from there.
I love it. So kind of touch real quick on this tech startup. You mentioned, they're buying single family homes. What is it that they do? What's kind of their strategy?
Um, at a high level, primarily because like I'm not a spokesperson for them. So I will just sort of on a high level sort of touch that.
Perfect.
They just invest in portfolios of single family homes. So yeah.
Okay. Nice. And it's available for people to like get into that kind of thing. Oh, got it. Okay.
Yeah, so that's
Interesting.
private. Yeah.
Got it. Nice. Okay. So you obviously created your fund. You're a fund manager.
Yes.
We haven't talked to too many fund managers. I've kind of explained it on some of my solo episodes, but just kind of give a high level of, what that entails in terms of, being on that end of things.
Yes, great question. So fund management. So this is where you as a real estate, either someone who is seeking to put deals together, like actively going out there finding deals, you as an operator, wearing the operator hat, you could say, okay, you know what, I want to create a fund. Or someone else who says, you know what, I have a lot of experience in the real estate space just from investing passively, which has been my path, as well as there was a path of seeking to be very active on operating and finding deals, and then going through that process and then sort of realizing, hey, that's not where I want to be. And like, that's not where my skill set best lends itself. So essentially, those are pretty much the prototypes of the individuals who will create a fund. And the idea there is you come up with what you plan to invest in. So that might just be, hey, I'm planning on investing in commercial real estate projects. And if you're going to do a blind fund, then you need to be even more specific than that. You need to be very clear about like, okay, what types of projects and the types of returns people can expect, and et cetera, et cetera. But there's so many different fund types. Blind is the primary that most people know, because if they think about like their retirement account, for instance, with their employer, chances are they are investing in a target date fund with Fidelity, John Hancock, or any of the big, investment managers that are out there. And that's a blind fund. Like it's the target is that in 2025 or whenever 2065, it's going to start paying out, money to the people who are in that particular, who have invested their money into that fund. You don't get to choose all the different investments that are in the fund. You trust that the fund manager at Fidelity is picking the right investments. So it's almost like your money is getting on a plane at Fidelity, and it's this retirement target date fund plane that's going to land in 2065. And when it lands in 2065, it's going to start kicking out cash flow based on all the investments that has gone on during that time. So that's the concept of the blind fund. The type of fund that I have set up is not blind. It enables investors to choose the type of deals that they want to invest in. So it then gives you the flexibility as well as diversification of being able to come into the entity. And then once you see a deal, that's only when you decide to deploy capital. You don't deploy capital before that, because I believe that once you put money into an entity, I believe the preferred return on that money should begin starting to tick. So that at a high level is sort of, the approach within the fund world. I think the third thing to note, besides these types of like being able to come into an entity and be able to choose, there's also the traditional SPV, special purpose vehicles, which are usually entities that are set up to invest in one specific entity or a specified offering, hence the special purpose vehicle. So those ones have been around for a while, which are also considered fund of funds, because you've created an entity that's investing in another entity, which is ultimately the real estate investment, the syndication.
Absolutely. That was an incredible explanation. Thank you so much for that. And just to kind of give a little bit of explanation, the SPV that she's talking about, basically single asset fund, whereas her fund is, going to have multiple assets,
Correct.
which you can choose, you can see them, you can see the returns,
Yes.
decide if you want all of them, one,
Right.
whatever it may be. So along those lines, what are some of the things that you talk about? You talked about fidelity managers and we don't know them and what they're doing. And one thing that I always find so interesting is how people, are just blindly trusting these people. Meanwhile, they know us and still are hesitant. So what are some things that you help people to decide if passive investing is right for them?
Yeah, great question. So I tell people a couple things. Number one, are you someone who feels that you need to be in control of every part of the process? If you feel that you need to be in control of every part of the process, then I think that going and being like seeking to play actively in the real estate space might be a good idea for you. That's the first thing. The second thing is, are you in a position where you have a very lucrative job or business? If that is the case and you don't have abundance of time, and you really like what you're doing. So if you really love what you're doing and you're in a situation where you're generating lots of income, but you want to be able to place that income to work for you, so that way you have that income is working and it doesn't just sit in your bank or it's just in the stock market. Like, not everything is in the stock market. You're getting diversification into real estate, commercial real estate, or just maybe even residential real estate, to the extent that that's your choice. That's where passive investing, in my opinion, becomes very important. The other thing is diversification. So even as an operator, many operators are focused on a particular area and market and asset class, which makes sense, right? Because like, you want to be an expert in that particular Phoenix multifamily or self-storage or industrial or hotels or whatever. But by embracing passive investing, it enables you to deploy your capital in markets that you're not personally playing, to get exposure to those markets and asset classes to diversify your portfolio. Lastly, your retirement accounts can't technically be used in your own deals as a syndicator. So that's how a lot of syndicators then end up passively investing in other people's deals, because their retirement money has to be in syndication deals that are different from their own.
Wow. That was an incredible explanation. Thank you so much. And I hope you guys were paying attention there, because so many incredible points made. You even kind of alluded to one of the benefits, at least that I've talked about, in being a fund manager and kind of taking that approach, is it allows us to identify the top operators in the top markets in the different asset classes and, invest in their deals. Right. Without having to develop the relationships. Because what you guys need to understand is, in order for these operators to become the best in their markets, this is years and years of broker relationships and boots on the ground and shaking hands. And, by leveraging someone like Lisa, you are also in turn leveraging those operators, because she has a skill set to identify those operators. And if you're too busy, you have that income, like you said, but you're too busy to really take the time. All it takes is a phone call with Lisa, and then she can go out and find, the asset classes and things that.
As you mentioned this, I would like to share probably why I decided to do a fund.
Would love that.
Yeah. So I was trying to solve my own problem. As someone who's in this space like you, like, I get tons of deals all the time. And as operators send more and more operators send me more and more deals, the minimums are usually between 75 to 100K. And some people even want higher minimums than that. And I thought to myself, okay, I have 100K, one between 100 to 200K to invest here in 2022. And if I go by the deals that I'm seeing, that's probably going to give me like two deals if I go into two deals at 100K each, or, whatever, like three deals at best or whatever. And I thought to myself, couldn't there be a scenario where I could go into more than one deal? Like my 100K could get me into four different deals at 25,000 each. And I thought about it and I was like, well, like that would mean creating like a fund vehicle that would enable that to happen, and the diversification. Because as you go along, like I've met a lot of really good operators that I trust across these different, markets, and wanting to be able to play in their deals and participate. So I was like, well, I'm pretty sure if I feel this way, there must be other investors out there like me who are saying, you know what? I want to deploy 100K this year too, but I don't want to put it all in one deal. Like, is it possible that I could get the opportunity to invest in that deal and maybe put 25 and then 25 in a multifamily class A minus, and then one in a multifamily C, and a self-storage self-storage opportunity, or maybe an industrial or a self-storage opportunity, like mobile home park opportunities. So like you're able to diversify your capital across different asset classes, different industries, different operators, and you have the ability to control where your money goes. Like if you don't like it, this is not a blind fund. If you don't like it, you don't have to put your money into that one. You can just say, you know what, I don't like that one. You see the next one, okay, I like this one, I like the numbers on this, I like the operator team, and then you go from there. So that's what I was trying to solve, my own problem, and that's how I then ended up in this place of then creating a fund. Is I saw that, and then of course I had the fund experience from 10 years working as an auditor, auditing funds across three different cities. So the Cayman Islands, Boston, and then LA, and then leaving to go work for a fund manager, and then working for a fund manager now. So like I just live in a lot of funds, which I was just like, well, how can I use the skill sets, the toolbox that I have to then best leverage building a business in this space?
Awesome. I love that. Yeah, you made a lot of really, really great points. You kind of mentioned a couple things, looking at the numbers, the operator. What are some other keys to determining if a deal is right for you as an investor?
Yeah, great question. So, couple things. One, I like to build relationships with the operators. So I like to get to know who they are, and understand like their underwriting, their approach, how they play in a particular market, their sweet spot buy box in terms of what it is that they are really good at buying. Because then as I see more and more of that, like I feel more and more confident that they are able to execute on that particular strategy. I then also ask around my peers. One of the benefits of being in all these different groups is like you have the ability to have a network and be able to say, hey, like, have you worked with this particular operator before? And like, what has been your experience with them? I believe that having that is invaluable because it enables you to get, on the street information from other people. The other item that I do is, obviously look at the underwriting and look at the markets. So there are certain markets that I seek to focus on playing in. When I'm introduced to a new market, that of course will take me time to get to know that market. So there's just added time for that. But beyond that, like once I'm comfortable with that market, then it's easier for me to sort of say, okay, this makes sense to me in terms of what they're projecting, and to go from there. With my fund, I, of course, one of the things that I've sort of sought to build into is like using even third-party underwriters to give me a second opinion professionally on some of the deals that I look at. And the same thing for, even having an attorney to look over the PPM documents of deals that I'm going into, just to make sure that everything looks good there as well. Primarily because you are making these decisions that are also not only going to impact you, but like the investors who are coming into your fund. And to me, I feel like that's some of the benefit of having the fund, is being able to do some of these kinds of things. So, yeah.
Absolutely. Couldn't agree more. What's one thing, obviously you mentioned you're bringing in third-party underwriters. For those investors who don't have time but want to understand at least the basics of it, what are some things they can do in terms of
Yeah,
like
great
understanding
question.
underwriting?
Yeah, great question. So there's a book that Brian Burke wrote called The Hands-Off Investor. It's a bigger pockets book. I highly recommend that for all passive investors to read as they're thinking about deploying capital into commercial real estate syndication deals. He goes into a lot of detail, in terms of like some of the things to think about, look at, ask questions to ask. And he also noted that many of the questions, like, you don't necessarily need to ask them, but you can they should be things that should be forthcoming, like automatically, like FAQs, like frequently asked questions, or stuff that's in their operating memorandums and agreements. So like their values, core principles, the key assumptions that they're making, sensitivity analysis that they're doing, some of the different strategies that they're thinking about in terms of exit strategies that they're thinking about executing. And then things like, challenges that people have ran across during their business, like that, you probably are going to need to ask to say, hey, have you ran into challenging situations in the past? And like, so how have you sort of handled it? I think is a great question to, assess someone's tenure in terms of continuing to build in this business. So, yeah.
Awesome. That was a great answer. Thank you so much. And one thing to note, guys, especially, the last few years, if operators are new in the sense, they've been around for 3 or 4 years, we've been in a huge bull run. So keep that in mind as well. Some operators may not have run into anything heavy in terms of issues. So just something to keep in mind,
Yeah.
kind of going forward.
Yeah. Great point.
So one thing I haven't talked about a ton on this, but is a point, especially with this economy moving forward, the difference between investing for cash flow and investing for appreciation. Can you kind of touch on that?
Yeah, great question. So investing for cash flow versus investing for appreciation. So when looking at deals, I prefer to invest for a mixture of both. I like to see a blend of both. And that, of course, makes it harder to find some of these deals because with higher prices, it's a little bit challenging for some of the deals to cash flow because you're paying more for them. So really and truly, you're betting on the price continuing to increase, like the price of the real estate to continue to increase in order for you to actually make money when it actually sells. So I think it's controversial to say that prices are going to continue to increase. Historically, playing in the right markets, and if you have a long-term view, so like 7, 10, 15-year view, I think that yes, overall, especially if you're playing in the right types of markets, you're going to see an increase in price. I think that where things get tricky is if you are playing for appreciation and you're in a short window to do it, like 2 to 3 years, like most people are in. And for some reason, you have some kind of softening in the market that causes the prices to go down, and you're unable to achieve the kind of exit price that you want. That could then obviously have massive impacts on investor returns. So yeah, I think for me, I try to work with operators. I seek to find operators that are taking a very conservative approach. So what does that mean? Because that's also another controversial
It's very subjective
response. Yeah, it's a very subjective. Um, to me, I want to see the ability to hold on to the property as needed. I think that is key. Like the ability to have the option to not sell if you're not in an opportune market. I think that is what's going to make or break investors' returns in that sell part. The other part of it, obviously, is asset management. Like that's always critical, like actually getting, operating the asset to achieve the returns and like being able to execute on the business plan and knowing when to pivot and like when to not do certain things, or to pause renovations because we're in the middle of COVID and like, you don't specifically know what's going to go on and stuff like that, or to do renovations as people request them, as opposed to just doing them blankly across the board. So things like that. I think it's just a lot of like deep intelligence in the market and being able to like pivot and make changes.
Absolutely. Yeah. Huge thing to pay attention to, especially moving forward. Certain markets, there are strategies right now that are, 1 year, 2 year, 3 year
Right.
strategies, but you need to make sure that they have a contingency for if they need to hold on to it for 5 years. What does their debt look like? Their financing,
Yeah.
different things like that. So what are some quick glances we can do to kind of take a look at that and make sure that they, may have that contingency in place?
Yeah, a couple of things that I look at is one, the debt, as you mentioned. What about the debt? Well, the loan to value ratio, as well as the interest rate, whether it's floating or fixed. If it is floating, is there a cap? If they are going into a long-term loan, what's the prepayment penalty on that? And sort of, whether they've assessed both ways and what their plan is. I think that one of the beauties of this fund model is that you have the ability to diversify even across debt, um, strategies, because the reality is no one really knows, and permanent debt isn't necessarily always the answer, because I have been in deals. I've invested personally in 6 passive deals to date. So I've been in deals where they've had to pay large prepayment penalties to come out of their debt, or they had to sell the asset at a little bit of a discount, but they still were able to achieve really good returns for their investors because it was a loan assumption, the buyer was taking. And anytime there's like that loan assumption, they're usually going to get like a little bit of a discount because they are assuming your loan. So those are some of the things. And then the other thing too is the assumptions. So the assumptions around expenses, the assumptions around income. So for apartments, depending on the asset class, I would say like if you're going down into like the class C's and stuff, you're roughly around, between 40 to about 50% of the income is the expense number. So like seeing it around that area, if it's much larger than that, like maybe they have a play to help bring that down. And then if it's much less than that, like understanding what their plan is, like how they're planning to achieve that. It doesn't necessarily mean that it's impossible, but it means that you have a conversation with them to sort of understand where they're coming from and like how are they seeking to see this. And this is why like, being a part of groups and like being like having the ability to like also hire underwriters to get a second opinion and stuff like that is very important, because like um some of this stuff, you don't always know every single thing, right? So like you're getting different pieces to make sure that you're covering all the different grounds, so to speak. And then yeah, like projected rental income, like to me, I think having in the fund a mixture of some deals that might be um, seeking to achieve their returns based on pushing rents versus having some investments that are seeking to achieve their returns based on, a management play, like better expense management and that kind of stuff, or even adding additional income streams such as like covered parking and like that kind of stuff. Like being able to sort of like right size your investment portfolio across those different kind of those different kind of strategies, in my opinion, helps to sort of protect your money in a way, because like you're not like all in deals that are all seeking to increase rent, because like maybe some of them aren't able to achieve that because there's a turn in the market. So you're doing your own due diligence to sort of understand what's the business plan of this deal. Like how many other deals have I invested in that are trying to execute this type of business plan, and then getting that kind of diversification in there as well.
Wow. So, yeah. That was incredible, because not many people talk about diversifying across business strategies as well, in terms of, long-term debt, getting into a deal that's got a, 10-year agency loan on it, but only because 4 of your other deals have bridge loans, and
right.
Being like, okay, now I can kind of hedge and, if there's a big turn, I can kind of weather it because I've got this other. So that's super powerful.
And that's the beauty, right? Because like if you had your 100K and it was all in one deal, like now your 100K is now 25 across 4 different deals, different asset classes, different business plans. Like to me, inherently, I feel like, and keeping in mind that each operator you vetted and you're comfortable with them, right? So like, to me, I think that's a better place to be. I think that that's a better place to be than to be just all in one spot. That's just my thoughts. So yeah.
Awesome. I love it. So powerful. Thank you so much. That's incredible insight. I wish we could keep going, but we are kind of coming up on time. Yes. But I have 5 questions I ask all of my guests. It's the final 5. What's the best advice you've gotten from a mentor?
I would say this quote from Sarah Blakely that I always have here on my computer. It's called, "What you don't know can be your greatest asset if you let it, because it ensures that you're going to do it differently." So I would say that.
Wow. That's awesome. I love that. What is it about your career that makes you feel like you're fulfilling your why?
I would say that contribution and impact, like being able to see that my work contributes to the bigger picture and is impactful.
Awesome. I love that. Favorite non-real estate or investment related book?
I would say, gosh, I think the Who Not How.
Nice.
That Who Not How book is so good.
Such a great book. That came with our starter kind of package for Raise Masters, just so you guys know. But incredible book. Dan Sullivan has so many great books. But this is basically, well, the irony of this book is it's not even written by Dan Sullivan, but basically it's his idea that, and I've done a whole solo thing on this, but basically hiring out everything else except for your unique ability, which is a hard thing for entrepreneurs to kind of grasp, truly. Yes. Was that hard for you?
Yes, it still is. Oh my goodness, it still is. It still is.
I love it. Well, you're a finance person. I get it. Finance, something about our analytical brains. We have to have control. Something about numbers. You have so much control over them that that extrapolates out to life and business.
This is true.
So if you could have any superpower, what would it be?
I think it would be, gosh, this is a hard one. I think it would be like better being able to like create processes and like delegate. like super delegator and super process creator.
I love it. Back to who, not how.
Yes.
Nice. And last one, what's the best way for people to get a hold of you and learn more?
So the best place they can get a hold of me and learn more, one-stop shop, is lisahylton.com, which is my website. Everything is there. You can find episodes from my podcast, which is called the Level Up REI. You can also sign up to chat with me to learn more about my fund, in the lisahylton.com/invest. And I have tons of articles on my website. You can sign up to learn more about all different passive investing, good stuff. Is everything is there. So it's a one-stop shop, lisahylton.com, and that's Hilton like the hotel, only thing with a Y.
Awesome. We'll link that in the show notes. Lisa, thank you so much for your time. So much great insight. I really appreciate it.
You're welcome. Thank you for having me.
Absolutely. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, you know it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.